Hello and welcome to the Tax Roundup for November, and we have a huge amount on this month. First up, we're looking at how the government is moving to simplify some of the employer obligations, so things like PAYG withholding and also contractor versus employee. We're looking at new legislation that's been introduced into Parliament, following through on some of those important budget changes. We'll look at a new FBT ruling on recreational facilities, and finally a trust case that you really won't want to miss. First up, across to Mike to look at those employer obligations.
The Inspector General of Taxation has announced a review into the way the ATO handles audits and reviews of employers and whether they've met their employment obligations under the tax system. So thinking about things like superannuation guarantee obligations, PAYG withholding, and the FBT system as well. And as many practitioners would know, this has been a real area of focus of the ATO in recent years. Lots of cases have gone through the courts around this employee contractor type distinction as well. And so we've ended up in this situation where the Inspector General of Taxation figures it's worth reviewing the way that the system is operating from a fairly practical point of view. So there'll be two main areas of focus, and the first aim of the review is really to identify areas within the system that could be changed, worked around to enable employers to better comply with the rules. So ease the compliance burden that exists on them at the moment. And again, as practitioners would know, it is a significant compliance burden. Some of the issues that have been raised are that distinction between employee and contractor. It's not consistent across the different areas of the system. So what ways could there be of simplifying that for employers? The way the penalty system works, we've seen in recent months some progress in that area where the government has announced that it will change the way the superannuation guarantee penalty system works. So that's some good progress, but the Inspector General of Taxation, I guess, will be taking a broader look into this on other areas as well. On the other side of things, there will also be some focus around the way the ATO manages the compliance process. So the way the ATO conducts an audit or a review of an employer, is that being done in a fair way? Is it consistent across different taxpayers? Are the ATO asking for information and requiring input from employers that exceeds what is really necessary to get to an outcome? So these are the sorts of things that the Inspector General of Taxation will be looking at. Be interesting to see where this ends up, what sort of recommendations come out of that, but more importantly, from a practical point of view, what impact it really has on businesses who are trying to keep up to date and trying to comply with all the obligations that they're faced with. While we're on the topic of employer versus contractor type issues, we are running a webinar on the 10th of November dealing with that issue. So that distinction between employees and contractors, what businesses can do to try and minimise their risk, and also from an employee's point of view, the issues that they might face on that too. So join us for a coverage around that issue.
Now, Rae's going to take you through that new legislation that was introduced into Parliament with some of those important measures in it.
Okay, now we have another bill that's come up as a result of the budget changes that came through earlier this year, or that were announced earlier this year. This one is Measures Number 5 bill, and it targets 4 important things. So one is the FBT concession for salary packaged entertainment benefits. That's going to be restricted. Then you have third-party data matching reporting, so the tax office using that information they get from third parties and verifying and hopefully encouraging further taxpayer compliance. Then you have the zone tax offset changes, and that's intended to make sure that those who get access to the zone tax offset are those who are genuinely living in that geographical area, not just somebody who's there for an extended period of time. And then the final one, the one I think is of most interest to individual taxpayers, is the changes to the work-related car expenses. Now at the moment we have 4 different methods. 2 of those methods, the 12% of original value and the 1/3 method, are used by less than 2% of taxpayers. So those 2 are going to be gotten rid of. We will still have the remaining 2, but with the cents per kilometre method, which is obviously very popular for a lot of taxpayers, that will be even further simplified. We will no longer have 3 different rates based on the engine size of the car. We'll have one single rate, 66 cents per kilometre, and that should take effect from the start of the 2016 tax year. So hopefully simplified measures there will make simplified lives for tax advisors.
Rae is going to take you through the FBT ruling, looking at the FBT implications and what you do with that spare space in your office.
The ATO have issued some guidance for employers who are providing their employees with use of a recreational facility. And it's basically going through and explaining what the ATO considers a recreational facility to be based on the legislation. So you might think, we've got that spare room, we'll let the staff use it for their yoga classes on a Friday. Doesn't that make you a great employer? And we don't need to worry about any tax issues. But unfortunately, there are always tax issues. Because the use of that room, which could be used for other things as well, would not necessarily qualify it as a recreational facility. So providing it to the staff for their yoga classes can still result in a residual fringe benefit. However, if you provide them with the use of, say, a room that's been converted to a gym and has the gym equipment in there, then that could qualify as a recreational facility and there would be no FBT issues. So being a nice employer and trying to help your staff stay fit is great, but don't forget there will still be tax issues.
And finally, in cases this month, Mike is going to take you through quite an unusual case that looks at what happens when somebody doesn't realise that they're a beneficiary of a trust. And to get you started, the first line from this court case was, in 2000, when Miss Alderton was 18 years old and considerably less sophisticated than she appears now, she commenced a relationship with a medical professional. Across to you, Mike.
Now, one of the cases that we'll be looking at this month is Alderton and the Commissioner of Taxation. This is an AAT decision. This decision really looks at that idea of whether someone is presently entitled to trust income, so should they be taxed on income of a trust, and also is it possible to disclaim or reject your entitlement to trust income. Now, the facts of this case are interesting. The names themselves of the people involved have actually been changed, so it's not really Alderton, that's just a made-up name that's been used for this case. Basically what happened was an 18-year-old young lady started a relationship with a gentleman who was in his early 40s. That relationship lasted for about 10 years. The slightly older gentleman was providing funds to the younger lady. Midway through that relationship, the gentleman set up a trust and he would transfer money into the trust. The young lady was given access to a debit card and internet banking. She could take money out of the trust bank account using that card and the internet banking facilities. Now, she never lodged any tax returns declaring any income from the trust. The ATO issued a default assessment to her, including the net income from the trust. The ATO argued that she was presently entitled to the trust income, so she should be taxed on some of the taxable income of the trust under Section 97. Now, upon receiving that assessment from the ATO, the taxpayer objected to it and it ended up as an AAT matter. Now, the first thing that the AAT looked at was whether this taxpayer was presently entitled to income. The AAT said, well, there was income in the trust, the taxpayer was drawing money out of the trust bank account, she was presently entitled to the trust income. The second issue was whether she could actually reject her entitlement to that. Now, the AAT referred to some previous case law which suggests that it is possible for a beneficiary to reject their interest in the trust and their entitlement to distributions or gifts from the trust. However, there is a really strict condition, and that is that you have to absolutely reject the gift that has been provided to you. In this case, the taxpayer hadn't done that. She had spent the money. She'd taken the money out, she had spent it. It was only on realising what the tax implications of that were that she then sought to disclaim her interest. The AAT said that's not enough. You've used the money, you've taken the benefit of it, you haven't effectively disclaimed your interest. So as a result, this taxpayer was taxed under Section 97 on her share of the taxable income of the trust. Now, a couple of other interesting things that came out of this decision. First one, the AAT noticed that when the objection was lodged with the ATO and when the matter went before the AAT, the taxpayer solicitors hadn't sought to have the administrative penalties remitted. The AAT thought that was a pretty serious oversight and suggested that the taxpayer now go and ask the Commissioner to remit what were some pretty significant penalties. The second thing was that the AAT suggested this might be a situation where the taxpayer could ask the ATO to release them from the tax debt. So exercise the Commissioner's discretion to release them from the debt. The AAT thought that this particular person had the sort of circumstances that might merit the application of that discretion. Again, really interesting for the tribunal to be making comments like that in its decision. So the tribunal was saying, look, under the strict application of the law, you're taxable on that trust income. However, we think you might want to separately go and have a think about whether you ask the Commissioner to release you from that tax debt given the circumstances. The tribunal thought really that this older gentleman had taken advantage of this young lady and had really used this structure of a way of paying less tax for him personally. So interesting case, runs through some fundamentals in terms of the way trusts are taxed, but also some more practical and administrative scenarios as well.
And that's the tax roundup for November. Don't forget, if your firm is a member of Knowledge Shop already, register for PD if you haven't already. We're in locations around the country. We'll be covering 4 great sessions, and we'll finish it off with some Christmas drinks and a bit of Christmas cheer. See you then. Bye.